Welcome to episode 41 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Craig Dupper of Elan Growth Partners. Craig talks a lot about the concept of partner equity, that's really their approach at Elan. And this use of the word partnering, of course, is nothing new. Private equity uses it all the time. But Craig does back it up with numbers. Specifically, Craig and Elan like their sellers to roll 40% in their deals, a pretty high number, and they do that consistently. Getting the incentive alignment, of course, is what they're looking for. So the high number itself, I thought, was noteworthy, but it also means that retiring owners, which is a pond that independent sponsors generally fish in, is not really going to be a fit for Elan. They really want sellers who roll a significant amount and remain really invested in that second bite years down the road. So this really does feel, when they say partnering, like a true partner. Nicholas, you actually had a point on that was a little technical in the interview about pari passu. You want to explain that for the audience?
Sure. I can't remember whether or not there was a hard mandate to have 40%, but it was definitely a strong preference for a very high rollover. And that, of course, you do because you want alignment, you want continuity, and you want the partnership. Now, one nuance that I asked him about, because Craig is very experienced in the private equity world, I asked him, do they roll 40% pari passu? And so pari passu means on identical terms as the other investors. And so what you will often see independent sponsors do is that they will sometimes make the invested equity, so the new equity coming into a deal will be preferred. And so let's imagine a case where there's 10 million of equity and the seller is rolling 40%. So he's 4 million out of the 10. But often, or not often, but sometimes we will see deals where the sponsor says, yeah, the first 6 million of equity will go to us because we put in cash. And then the seller gets the next 4. And that's not pari passu. Then the seller is actually behind or junior to or not preferred, right? And I think Craig has experience with various forms of alignment and how to do equity checks and rollover equity. But he seemed to suggest a pretty good preference for pari passu as the best way to create true partnership. And it really aligned with what he said, that we are partner equity and not private equity. Is that what you meant, Will?
Yeah, that was great. Thank you. Any other thoughts on the conversation with Craig?
For me, one point I really liked was when he talked about value degradation. And so let me explain. When I am fundraising for Minds Capital, one of my talking points will be something like, we have a portfolio of deals, and within any given portfolio in finance, you probably want to expect or should expect 1 or 2 donuts in there, right? Deals that go to zero. And I say that a little bit just to, I guess, cover and sound conservative and sound realistic. But Craig actually takes the opposite stance here, and he's saying, look, for private equity deals, true private equity deals, you're buying proven, profitable, growing, well-managed businesses with proven business models. And so that they shouldn't go to zero. In fact, he argues that if they go to zero, you have not just not created value, you have degraded value. And I think it's a harsh way of saying it, but it is actually true. And there's always risk with leverage, of course, but his point is well taken and one that I quite enjoy. And I like the idea of well-vetted deals in this space shouldn't go to zero. These are stable assets with upside potential.
On that point, I liked how he distinguished between the investment value and the actual enterprise value. So you can see investment value. You can and will in traditional private equity sometimes see investment value go to zero. But that doesn't mean the underlying enterprise value has gone to zero, but just from the fund's perspective, it's been a write-off. And that's why he says you'll see countless examples of a seller selling to private equity. Private equity doesn't get the return or isn't able to re-exit that business. And so the seller, the original owner, founder, will come back and be able to buy the business for pennies on the dollar, effectively a donut for the private equity fund, but in fact, still an enterprise with a lot of value. Max, what did you think?
Well, everything you both have talked about are great insights on the episode, and the strong alignment between the seller and Craig's group with the high seller rollover percentage. And he did say I think he said the average of their deals is 40% that has been rolled, but that they sometimes will take less. If it's an older seller who is just not going to be around as long, that they will take a smaller role when it's the right situation. But great alignment there. One topic that Craig brought up that I found really interesting because it's close and near and dear to my heart, as always, relates to financial and just general diligence on these deals. And Craig, he talked up the independent sponsor model and deal-by-deal equity raise model in a way that notes that it promotes more diligence on deals. So you have investors coming in on a deal-by-deal basis, and each investor is performing some level of diligence on the deal, which is very different, of course, than if you're just sort of passively invested into a fund as a limited partner, and that private equity fund is then going out and making a series of investments over 5 to 7 years. You're not actively, as an investor, getting to say yes or no to each individual investment. So you have less incentive or really no incentive to do any diligence whatsoever. And you're not really invited to do that in a normal private equity fund. So the deal-by-deal approach allows each investor to diligence each deal and to bring really solid questions to the sponsor. And Craig had a good quote when he mentioned that they never accept no without asking for the LP's thinking. So if they're told no, they want to know why, because they want to know, hey, have we missed something here? Is what I got from that. So I found that to be very insightful. And I, of course, appreciate that as we're investing in independent sponsor deals. And I like to think of Minds Capital as another layer of diligence, of course, on these deals.
It was funny to hear him say that despite all his years of experience, they invariably do miss something. That for every deal, they'll hear something back from their LPs or their prospective LPs that they missed. And so it was really evidence about how these layers of filters that you have in prospective LPs and independent sponsor land really do provide their own sort of value, their own sort of market testing for a deal. Well, great. Minds Capital, as Max just said, invests equity in independent sponsor deals. So if you are a sponsor with a deal under LOI, please send it to us, mindscapital.co. And if you're interested in investing in Minds Capital as one of our LPs, there's a pre-registration form on the website for accredited investors. Fill out that form and you'll be kept in the loop on all future raises. Again, mindscapital.co. Okay, here is episode 41 with Craig Dupper of Elan Growth Partners. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Formerly a VP at Goldman Sachs and later a fund manager at Solus Capital, Craig Dupper, the founding partner of Elan Growth Partners based in Park City, now swears by the independent sponsor model. He argues that deal by deal prompts better due diligence, stronger alignment, and better returns. At Elan, they have built infrastructure, reporting, and tools to resemble a fund while maintaining that flexibility that enables their LPs to flex capital up and down depending on the deal. Craig Dupper, welcome to the Minds Capital podcast.
Thanks for having me.
In our pre-call, Craig, you'd said that in private equity, deals that go to zero should not exist and bring shame on the practitioners who preside over them. What did you mean?
Well, the way I define private equity, especially our strategy, is looking at cash flowing businesses with a history of an ability to produce that positive cash flow. So if a financial sponsor makes an investment in a business that's cash flowing in order to, with the hopes of improving that business, shame on them if they degrade value entirely.
Negative. It's actually not no return. It's a negative return.
Right.
The destruction of value.
Yes. And our goal is to accelerate value creation. And we're taking businesses that are good businesses and hopefully making them better, faster growing, more desirable businesses in the market.
What are the typical reasons that you see deals go to zero when you've seen that in your career?
I think it starts with underwriting. I think that the willingness to flex underwriting standards and convince oneself that maybe momentary cash flow production is solid or is proven. That's why when we look at businesses now, we look at a multi-year history, their ability to exercise the business model that they have built and produce positive cash flow. And I think that there are times when, maybe there's external factors that drove a year or two of positive cash flow, but I think the underwriter is mistakenly taking on venture risk rather than private equity risk, which is really, again, the way I define it is a growth and improvement thesis rather than a bet on an unproven technology, product, or service.
But why is it that there is this recognition or acknowledgement or appreciation in the industry for, yes, zero returns or going to zero happens every now and then. Everyone knows it happens and recognizes it, and that's why we have portfolio approaches. But why do people accept that and tolerate it at all?
Well, I think there's a couple of things at play, right? And they tie into the independent sponsor versus the fund model. So the independent sponsor model allows patience and preservation of value independent of time, because you're not constrained by an investment versus harvest period that are clearly delineated in a committed fund structure. And so you're either faced with, do I go ahead and write off the investment? And there are many times when investments are written to zero by the firm and the company survives and lives on after that time. But the manager wrote it to zero because they have these extraneous fund cycle concerns that, we've got to close out that fund. Yes, it was a portfolio of several investments. Hopefully the good ones outweighed that zero that I had to write off. I think that's an important distinction. I think it's rare to have situations where external private equity money comes in and the asset is reduced to truly zero value. I think that's different than the investment dollars going to zero.
Well, Craig, this would be the time to hear more about your preference for the independent sponsor model. So that was one thing that you just said there, but you're quite passionate on this point. So we give you the floor to celebrate this model.
Yeah, well, I'm passionate because the model is consistent with Elan's strategy. So Elan's strategy is partner equity, not private equity. What do we mean by that? Well, we seek to find existing stakeholders of businesses that see tremendous value in their companies that need a catalyst to help unlock that value. Because they see that value and they see a bright future, they want to retain as much ownership as they can. So in our structures, while we're control investors, and we can talk about that later, the reasons for it, but while we're control investors, we like those situations where our partners, our invested stakeholders, roll a significant portion of equity. Very often at the size of businesses that we target, EBITDA 2 to 7 million, there's significant cult of personality elements that are tied to the founders and the leaderships of those businesses and the existing stakeholders typically. So if they retain ownership, our incentives are aligned very well going into the future. And we believe, and our history demonstrates, that that's a de-risking element of our equity investment alongside these individuals.
When you talk about seller rollover, do you have a standard? Do you have a rule of thumb?
We like as much as they would like, up to 49%. If you look at historically in my entire investing career as a principal, that percentage is about 40, which is highly unusual. But that's tied also to the fund structure versus the independent sponsor model, because I can't go to an entrepreneur stakeholder or a founder stakeholder or a family stakeholder and say, yes, I want to acquire a majority control in your business or a majority stake in your business. And that big C word, the big control word, which smart founders and family owners highly value almost irrationally at times. If I am subjecting them to my fund cycle concerns, and again, it comes back to that fund cycle issue that I think has a definite impact on returns, because any fund manager knows that there comes times if you're doing a series of fundraisers when you need liquidity and you need to demonstrate a sale or an exit. A double could be good and could be enough that you need to push you over the line, given your portfolio, to be able to successfully raise a successor fund. And if I've got partners on the other side of the table, they signed up with me because we shared with them that our target is a 3.5 times our money net. That's a significant return, and that's significantly higher than a double. And for someone to sign on to my external running in the background, I've got to raise a fund, I've got to do a successor fund, is inconsistent with our partner equity strategy. So maybe, I think for other strategies, I'm speaking for Elan and for our partner equity approach in the lower middle market. And it's a value creation approach, not a portfolio or financial engineering approach.
You talk about there how a fund may not have the same amount of alignment, not because they don't want to create value or maximize their returns, but they have multiple incentives, which they are trying to trade and balance. One of them being, we need to get out, we need liquidity, we need to exit for our next fundraise. And your argument, as I understand it, there is an independent sponsor doesn't have that constraint on a deal-by-deal basis. And so you're more purely, cleanly focused on maximizing the value and thereby the partner equity, not private equity jargon that you use.
Yeah, it's much more, it's closer to the, many family offices have a similar philosophy because so this is tied to, and again, I'm not casting aspersions on the institutions that are seeking alpha in the private equity space that have a velocity of capital, consistency. They want to deploy very large amounts of capital over time. There's nothing wrong with that exercise. I'm not saying that's inherently wrong. I'm saying it's just inconsistent with our strategy and style. And so our institutional LPs, and they are institutional LPs, have a focus on a patience of capital, a multiple of money, not velocity of capital, return expectation. And the independent model gives us that flexibility in timing and perseverance, frankly, because the temptation, if you're raising a fund, and I saw this firsthand, is, well, we've got to wind things down. We're gonna, we've got to move on to the next fund.
So, but we are saying that the traditional fund model can cause the outcome for a particular company to be swept up in, as you put it, extraneous concerns. And so the independent sponsor model allows that whatever outcome or exit of that business, it's siloed and you can make a decision based purely on the interests of that business, those partners, the returns for that deal, as opposed to all these other extraneous factors.
Yeah, absolutely. That's why there's so many business owner and operators out there. And I think we've all heard the story of, yeah, I sold my company and 5 years later I bought it from private equity for cents on the
Right.
dollar.
Right.
Happens all the time, right? That the value of the business didn't go to zero. The value of the equity went to some much lower number, right?
Yeah.
If they bought it back.
Why is 40% rollover equity the magic number? That's unusually high compared to most deals that we look at. So why do you advocate for that?
It's not a magic number. It's what the actual number is in my investing history, to be clear. And again, our goal is we view the level of rollover equity as an incentive alignment tool, and that also gives us it's some underwriting protection, right? You've got a partner by your side that typically knows where the bodies are buried. They know a lot of the relationships that there's no way in a short courtship I can learn or diligence all the factors that typical founder owners of the businesses in the size that we invest in know. And you can sit across from a founder that says, no, I don't maintain all those relationships with key customers. I don't. I've handed that off to people already. I guarantee you they do, at least to a certain extent. So to have them on your side of the table and aligned with you and your interests because of that, super helpful.
And so how does the conversation go? And do you rule out and filter away sellers who don't want to roll equity?
Yeah. I mean, that's one of our underwriting criteria. I mean, we've done situations where you have, due to age or other factors, you've had some sellers that say, hey, look, I really do want to exit. I do believe in the future of my business, but I'd prefer to roll 20 or some lower percentage. That's not necessarily a showstopper for us, but it is another one of those boxes that are either checked or unchecked in our underwriting.
And how early in the conversation do you bring up the rollover equity and try to gauge where they are at?
We're attracting people on the deal sourcing side because of this partner equity pitch, right? So it's a very early conversation. If somebody comes to me and says, hey, I want to retire, I know they're going to make me roll 10% just to allow me to be focused during a transition period. It's probably not a fit for us, because without that connectivity, there's been situations where we've had that conversation and somebody said, well, my CEO that's been with me the last 10 years, younger than me, wants an opportunity to create some real meaningful wealth for themselves. I've given them kind of quasi-ownership or a promise of some ownership. At the end of the day, that structure looks a lot more like a partner equity structure to us, because the combination of the walkaway seller rollover and the continuing leadership roll in, if you will, gets us to that type of 75-25 kind of mix where we have aligned incentives.
Do they always invest pari passu with the other investors, or are there variants around this either at your company or generally in the market that you see?
It's been interesting because historically we've always had a downside protection preference on our equity dollars in. The justification being, you're taking chips off the table meaningfully day one. It's fair for us to have a nominal preferred return that is then that you get a full catch up on in the waterfall. But I am hearing now that there are firms out there that are doing pure pari passu rollover deals.
And so just to clarify, what you're talking about there is you go to the seller and you say you're going to roll 40%. But in the waterfall structure, let's say there's 10 million of equity all in. Yours is 4 million, ours is 6 million, right? 60-40. The first 6 million come to us. The next 4 million come to you, and then it's 60-40 thereafter. Is that the pref you were talking about?
No, the pref would have been the first 6 million to us plus a nominal, say 6% return on that 6 million. The next dollars are to catch up the 4 million's pro rata share of the 6% that we took. And then it's pro rata after that, the 60-40.
I see. Okay.
But what I'm saying is in the marketplace now, we're seeing some firms willing to make rollover pari passu with theirs with no pref. So, and we have proposed in a couple of scenarios.
Isn't that fair too? I mean, especially if
Well, from the seller perspective, yes. I mean, I think the justification in the past was more market, and I do think you can make an argument that since we're enabling you to walk with meaningful cash on the day of closing, especially for the seller that may not want to stay as involved directly in the business as they were prior, I don't think it's unreasonable.
Is this usually very crystal clear or more opaque, and the average business owner is not aware and doesn't know which questions to ask?
We bias on the side of crystal clear because we're entering into partnerships that I don't think it's a stretch to say it's like getting married for a targeted period of time with a known, or at least a targeted separation date, right? And the worst thing I can do with a partner is make them feel like they were taken advantage of, or that I let them correct their own mistakes. You know, the old, well, they didn't notice it, so I slid it by. So we're very explicit, and we explain our rationale for both positions. And I hope and most of the time they advocate for themselves very well as too, but we don't get emotional in those conversations, because the idea is we're trying to structure a partnership that's fair in both of our eyes and that de-risks the execution of getting the company to the next level.
Do you get GP interest on the rollover equity typically or not?
There's not a standard.
Okay, got it. So sometimes you can charge carry on the seller and others not, that there's not consistency in that.
No, I mean, I would say market is you don't get carry on the rollover.
Thank you. I'm going in depth here, but I'm appreciating it, Craig. One last question on that particular one. What's the downside of giving too much rollover equity? Are there situations where 40% was too much?
Well, when you have a swimmingly successful investment, you'll have investors say, wow, I wish we had more, right? Which is, hindsight is 2020, and you'd always love that, right? I think that by far the incentive alignment is extraordinarily valuable, and I can't think of many downsides other than, wow, we really messed up in our underwriting and we didn't understand these people, and that really hasn't happened, to be honest. I mean, in my career so far, I think maybe that's a laws of nature thing. But I think the incentives are aligned, and, not that, everyone always sings Kumbaya together, but right. I think at the end of the day, the incentives of seeing it in game where value is more than it might have been otherwise for everybody is pretty powerful.
And this partner equity mindset, how does that translate into stock options for the management and the broader team? What is your approach and philosophy on that?
So we always, and we're very explicit about this on the front end, because especially entrepreneur and founder owners are always reluctant to share real equity, right? And one of the transformational things that occurs after our partnering, and what we tell them we're going to be able to do, is attract better talent as we grow, because we're able to meet equity incentive plans that competitors for scarce talent are going to be providing. So we always have an incentive pool. It's depending on the industry, how broadly, because you can have some industries where lower level they prefer cash bonusing type things rather than equity. But in the C-suite, for sure, there's broad equity participation, and that's ratably dilutive on everybody.
Craig, one of the profiles of seller in the lower middle market is, of course, the retiring seller. And you've already mentioned how age of seller can at times complicate the partner equity model that you have. But aren't there opportunities for businesses where you see a great growth opportunity, the seller really wants to exit. There isn't somebody underneath the seller who's going to come in and be your partner and roll the equity that you want them to. But that you could bring an executive who shares your vision. In fact, you've pre-screened them and put them in and get the growth partnership you want that way. Why does it have to be the founder that you're partnering with as opposed to somebody you bring to the equation?
Well, I mean, let's define partner a little better, because the scenario you outlined happens, and they can be my partner with objectives that are non-operational, right? Because they have ownership. And if we, in our planning before we close the deal, because all these conversations are had very early on, where we say, what are your objectives? We ask a founder, what are your objectives 3 years, 5 years from now? And to really suss out what they want their life to be like. And even young founders can often be like, hey, I'm not loving the administrative part of being a CEO of this business. And the idea of me being able to do what I'd like to do, be a chief sales officer or even executive sales leader, so I can maintain these relationships and I have my board position. Yeah, let's find an external operator. And that can be an attractant for our model, frankly, because we can bring a leader from our database of connections to run the business. That leader's excited to have a more typical incentive structure as a hired gun, if you will, in that business. And that's a partner equity deal for us.
Craig, you mentioned life planning there, and you're talking about the seller's life planning, and just reflecting on my own experience, as you said that sellers who are exiting at less than 5 million, they need a clear game plan for their life ahead, because they now lose their income source. So for add-on acquisitions and so forth, this question always comes up, right? Okay, this happens, but they'll have a lot of questions around taxes and future income streams to the extent continued involvement can help. And then you have sellers who are somewhere north of 20 million. They will usually care less because they're making so much money that they can live off of interest alone on a go-forward basis. But anyway, I mean, how does that conversation go when you say we discuss life planning with sellers? How do you lean into that? Like, what's an appropriate area or extent to which you engage in a topic like that?
Well, again, we're building a relationship, and it's a fairly intimate one. I mean, we're getting to know each other very well. We're trying to build trust. They're trying to build trust in us. We're trying to make sure that we're reading their wants, needs, drivers correctly as well. So I think everything's on the table. I think at a very base level, we're capitalizing on the thinking that goes as follows, where you have, I could sell my business today in a typical outright sales structure where I roll 10% and this X or Y value would go to me in that scenario. Or I can continue to operate, have all my eggs in one basket in my business. I'm getting a good cash flow income out of it, but I'm stressed out and I'm worried that, if there's any downturns, I'm all alone, et cetera, et cetera. Or I could partner with a firm like Elan that has a partner equity structure where I can de-risk a little bit today, take some meaningful dollars off the table today that allow me to sleep at night and be a little more comfortable about my downside personal situation, and have the professional investor at my side that's highly incented to generate a very nice return on this incoming capital in a shorter time period, hopefully, than I could do on my own. That's the calculus that we're spending time talking about. And it's not a fit for everyone, but it can be pretty attractive for that business owner that sees especially near and medium term value increases in their business, or potential for that with some ingredients that we can help bring.
The conversation about the flexibility of the independent sponsor model and the exit of a business not being dictated by extraneous features related to the broader fund. What does that mean for LPs? So in traditional private equity fund model, LPs like to see those liquidity events so that they can get some of their capital back and then maybe redeploy it with the same group. Here, where you're not promising or indicating that you'll return capital necessarily on such a well-scheduled timeline, LPs have to be more patient, fair to say. How do you think about what they want in this model?
Yeah, no, we think a lot about what they want because they're the closest thing to our bosses, right? So I think that again, it's who we end up targeting, right? The more endowment model focused, multiple of money, patient capital investors are attracted to our model, and you're seeing more of them. You're seeing more in the institutional marketplace with kind of the evolution of the independent model. You're starting to see specialty funds that are being raised to invest purely in independent sponsors. We've got a couple of those relationships. It's interesting in those because they have the fund constraints. There's typically some time-bound expectation built into their investment. We're comfortable in those scenarios because it's typically structured in a flexible way to where if we were to need a new LP at that time, just because they needed to get out for time, it's due to their time constraints, we'd be able to do that. But that still maintains our flexibility, right?
Mm-hmm. And what does that structure look like, just for reference?
We've had 6 or 7 years in some cases.
But so, what is the kind of the mechanism where you can provide that?
They have the ability to give us notice and say we'd like to be replaced as an LP, and there's a prescribed
valuation
marketing process that we do that we agree on the valuation and the process that we're going to go out and find a replacement LP or sell the business.
Mm-hmm.
But again, we have that optionality. If it's not the right time to sell the business, we're going to be able to find other LPs that are more endowment focused that don't have a problem signing on to a fair value deal at that point.
Is this a put option that they're exercising or less formal than that?
We've seen it written both ways. But in substance, it's a put.
All right. So you have to act or do a best effort.
Or you negotiate again. And these are all relationships, right?
Right.
And those scenarios, it's incumbent upon us to be able to maintain the communication and transparency with our limiteds to where they're trusting our judgment and our guidance. I mean, because even a velocity of capital fund to funds that feels like I've got to get out because I've got to close out this series or this particular fund, if I can have a conversation with them and they've been tracking all along and they realize, hey, it's going to take maybe another year, another 2 years, and there's a tremendous amount of value creation there, that's not a bad conversation in most cases.
Some of our LPs at Minds Capital will ask us whether we require or request put options in the deals we participate in. And I would love to have put options in every deal. I mean, there's value, right? It's an option.
Yeah.
But and positive value for me is negative value for the independent sponsor. And in their case, it's dilutive and at the expense of other shareholders. So if I exercise my put option, let's say I own 10% of the company, that cash has to come from somewhere. Maybe it's internal and it's a stock repurchase, or they need to bring someone in, which is an opportunity cost of time, if nothing else. So from that vantage point, I've just landed on the conclusion that it's not independent sponsor friendly of us as an independent sponsor focused investor to have that on our wish list on a regular basis. Now, of course, if you exert them to other investors, we would want to have one too, but that's why I've been shying away from them being on my side of the table. But it sounds like you're open-minded about it and pragmatic.
Yeah, well, I mean, I think, again, this is a relationship business. It's a long sales cycle business. It's somewhat small relative to others. So I think the recognition, we try to choose limited partners with some screening criteria as well, because we're going to have relationships with them going forward. We want, it's not just dollars. It's input and so there's kind of this selection process that I think mutually works out. And while you can have the protection, I can totally respect the protection they need because of their fund cycle constraints, but I also maintain a level of communication that if that were to happen or need to be exercised for them, we'd find an elegant, fair way to resolve it.
Craig, the point about patient capital, and you're seeing, you said, correct me, that we're seeing more patient capital LPs in the market. You also said something interesting in the pre-call about how convincing that you can illustrate why a higher MOIC but over a longer time is preferable to a short getting capital back in a shorter time frame. Share that with the audience, please.
Well, I think and it ties to what I refer to as a velocity of capital focus versus a multiple of money focus, right? A MOIC focus. You tend to have more thinly staffed groups like family offices, some foundations, things like that want to be able to park capital that they know is going to have a nice return in terms of multiple of money. They're much less sensitive to IRR. They also typically don't have fund cycle constraints on the back end like other institutions do.
Right. Well, you had said this point about would you rather have 2.5 times in 3 years or 5 times in 8 years? So my which of course speaks for itself. My impression was that there are people out there who still need to hear that. So I was just curious if you're out there convincing the market at times.
Well, I think I'm not going to be able to convince a segment of the market because of structure. So I think, for example, fund of funds that are on fund cycles themselves are velocity of capital portfolio based by their very nature, right? And so they are constantly churning, they're raising, churning, and they're benchmarking a little bit differently than a foundation might be. We still have fund of funds that like to invest with us. So that's not an excluder, but we have these conversations about, we're in this to maximize the multiple of money return, not necessarily IRR. And, I've had IRR deals where I've had limited say, dang it, now what am I going to do with that capital you just returned? I've got to redeploy quicker than I anticipated. Love it, but, now it's got to find another home. And if you put yourselves in the shoes of a fairly thinly staffed limited partner that has limited ability to diligence individual deals, that can be a real issue.
Craig, at the top of this, Will said in the introduction that you guys have built out infrastructure to resemble a fund while operating as an independent sponsor. What does that look like exactly? What is the infrastructure?
Sure. And it's something that we really consciously focused on, and it's taken an investment, frankly. Thank goodness the technology's advanced that it's not a exorbitant investment, but it's a thoughtful approach. Being in a fund reporting structure where you have very high expectations of institutional limited partners kind of trained us that transparency and accessibility to information are absolutely paramount. So we've invested in the technical tools that provide all of our LPs an investor portal access. We report quarterly on a very rigorous 10Q-ish type time schedule. We're not late. And we audit our investing entities of the SPVs where required, and are very prompt with tax documents, things like that. And importantly, we're completely accessible to our LPs. So if they have a question on any of our reporting that we provided them that includes not only the raw financials, but an MD&A, and then that comes from the company, and then our perspective on that feedback. So the only difference between the way we behave in a committed fund structure, and I've been in both, is the fact that our LPs have that optionality at the beginning of a deal to flex up or flex down.
Which portal do you use?
We use Juniper Square.
And when you I assume you outsource tax preparations to a third party, but what about internal reporting? Is that something that you and your partner take care of, or how do you fix
Our
that
internal
on a quarterly
reporting,
basis?
we're working with our portfolio company CFOs, and then we prepare our report based on their input in that report. And then we provide the raw financials that they provide and any highlights in an attachment that then we have our cover analysis is. So if our LP wants to read, very quickly, we give them a high level, this is what it is, here's the financials, and this is what we're getting from the portfolio company. And then we coach our portfolio companies to produce those materials, which make them, it's a value creator on their side because they're used to this cadence of reporting. And it's tied also closely to board discipline. We institute a board discipline at the company level where we have actual board meetings. We have agendas that are distributed ahead of time. We include annual planning with key milestones. So those board meetings are not just tea parties around the table to discuss the issues of the day. They're how are we progressing towards the goals we set up in our annual plan? What roadblocks can your board help you remove if there are any to execution? How can we be helpful to and supportive of executing the plan?
So it sounds like investor reporting is it's actually quite labor efficient because you use technology for the portal, you use outsourced for tax, and you delegate to the portcos when it comes to the actual reporting.
Definitely.
And for that reason, I would imagine you can also control your annual operating expenses pretty good.
Yes, for those things, yes, we know with a fair amount of clarity what they're going to be. It's always nice to find savings, and I think the technology providers are getting smarter and smarter with their value added, but they're also pricing accordingly. So we'll see where that goes.
And you said that you file taxes on time. So what does that mean exactly? Because April 15 is one deadline. The LLC deadline is September 15, and then personal tax returns extended deadline.
To be clear, we provide K1s or estimated K1s that enable our LPs to file on their timeline. We're most of our LPs and even our operating entities are October filers because of the LLC pass-through time-consuming nature of those preparations. You have to close the book at the company level, and then all that has to flow through.
And so you would say sometime in Q3 is fair and realistic for an independent sponsor.
Yep.
Yeah, for taxes. Yeah.
Yep.
Craig, one of the other features of the independent sponsor model that I heard you say you like is that because you're raising deal by deal and you're going out to capital providers with a live deal for them to decide if they want to invest in it, it's just collectively more eyes and brains on every deal. I thought that was an interesting point that we hadn't heard, but is a pretty strong one. Elaborate, please.
Yeah, no, I mean, having been in what is the more typical investment committee that includes the partners of the firm, occasionally an outsider or operating partner with some sector expertise, there's no comparison to the process of circling the wagons among your limited partners on a deal, because they each have internal underwriting committees, and as institutions, they have a much larger experience set than we could ever have because they've got fingers in all kinds of deals. And, as much as we focus on producing highly concise, thoughtful investment memoranda that we share with them, and we sit and scratch our heads and what risk are we missing? What are we missing? What else could we suss out here? Invariably, one of our potential limiteds will raise an issue that we go, hey, wow, I hadn't even thought about it that way. And so I'm a firm believer that not only is the independent sponsor better for Elan's partner equity strategy, but it makes us better investors because we're able to surface early potential issues. And they're not always or even most often showstoppers, but they're features that we might have missed that we can account for in structure and in process that can, again, our business is to generate outsized returns while managing risk. And if we can have a tool that helps de-risk us on the front end like that, it's great.
Yeah.
Can you contrast it a little bit more to how private equity funds don't have as many eyes and ears on a particular
Well, they
deal?
just don't. They've got typically, an investment committee. I mean, ours was 4 individuals. So you have 4 individuals meeting around the table that, depending on how the incentive structure at the firm is structured, have a vested interest in their deal or some other designation. I know that exists. And so to have purely external eyes taking an objective view, is this an investment I'd like to commit my firm to? That's a different exercise, right? The debate is different. The debate has no interpersonal elements to it. I mean, we have relationships with these LPs, and obviously everything's professional, but it's one step removed, which makes it more analytical by its very nature and a bit more sterile than when it's with your colleagues that you work with every day.
And you credited your limiteds, right? So the partners who are coming in, but I think actually we can also provide some credit to the people who don't participate, because every investor who even looks at this, will be stress testing your thesis and highlighting issues that they see or find or can think about from their backgrounds.
Well, and we take that to heart when we go through the process. We never accept from a potential limited, no, we're just not interested. We want a download of what your thinking was. And it's fair if they said, look, we didn't have the bandwidth to even look at it because there's so much in the shop right now. And so it was on the back burner, that's fine. But if it's something where we've had some back and forth, we really take the time to digest the download and the thinking. And, we obviously disagree with it at the end of the day if it's a deal we ultimately close. But it's valuable input and, again, helps surface some of those risks that we might otherwise miss.
Well, Craig, we've got you for just a couple more minutes and wanted to see if we could hear about one of your deals, maybe unpack one of them. Do you have one that you can share with the audience?
Yeah, and it's interesting because it ties into our prior conversation about motivations of the seller were to retire originally. They had his title was President COO, who had been with them for more than 12 years, operating the business, had done a great job building the company. They were intrigued by the idea of having a partner that could come in and help them realize their immediate liquidity needs, but also participate in some of the upside that we believed we were going to help them be able to unlock. They were in the space that they were assembling battery packs for aerospace and defense, healthcare, security, and industrial end markets. Didn't have true IP, but had tremendous trade secrets that made them protectable to competition. So that was a scenario where they had a more standard 15% roll in the go forward, which is a little higher than the 10. But the contributed equity of the senior leader that we were backing in the deal or sponsoring in the deal really put it in our partner equity strike zone. It was a scenario where, again, ours is a growth and enhancement thesis. You had a nice operating business with good margins, good longstanding customers, good capabilities. They had underinvested in their financial infrastructure and reporting. They were concentrated in a couple of customers that they had underinvested in a sales group to help try to, diminish or burn down a little bit of that concentration. Their designation as a women-owned enterprise was a wrinkle that we had to solve for with the change of control because it did matter to one of their larger customers. So we had to provide a creative solution to that to meet both the company's need for maintaining that customer relationship and also the customer's need for that designation. So we had kind of come to the completion of those more nuts and bolts, blocking and tackling exercises through COVID. We're fortunate enough to gain essentiality status right away because of our healthcare segment that had been relatively small prior to COVID that suddenly became very contributory. And before we were really done, I think there is, even in private equity, the venture guys always use the J curve analysis. I think in private equity, especially with the growth and enhancement thesis, we expect or accept a period of reinvestment of EBITDA into infrastructure that's going to contribute to an acceleration of growth. And it may not be a J curve. Maybe it's a bit more like a check mark. I'm trying to think of the best shape to describe it. But we were just coming out of that period after all the investments that we had made in company infrastructure, getting rid of concentration, solving for the WBE designation. And we're really hitting stride, and had just completed, we had engaged a firm to do a buy-side search for tuck-in acquisitions. And through that process, we realized, hey, this is a really special business. We've got very unique capabilities. There's not a lot out there that we could justify really paying for to add to us. And it was during that realization that we were approached by a small intermediary that had a relationship with a UK public company that, I'm a recovering investment banker, and you always look at company overlays and synergies, and this was the perfect buyer for our asset. They had a division doing nearly identical assembly work with a different customer base, industry speaking, in Europe primarily, and they were highly desirous of a U.S. presence. And so the end of the story is that we said we're not for sale because we're not done yet. And they said, well, how about for this? And we said, okay.
And how long had you held it?
We invested in 19 and exited of November, the end of 19, and we exited in August 22.
Well, so for all the talk of this patient capital, sometimes
it happens sometimes. It's been in my career, it's been as short as 19 months and as long as 20 years. So.
And so in that deal, it doesn't sound like you actually had to execute on much. You were kind of warming up to. But
we executed on a lot, but it was
you were still in the J curve.
Infrastructure. Yeah, it was the infrastructure enhancements that really made the difference. Because before we had been in there, the company would have showed very differently to this potential acquirer than they did after the things that we had done. Merely from a reporting discipline, availability of information, proving the thesis that if you added sales resources, they could produce. And, those are pretty key elements to value creation, I think, for the buyer.
And Craig, is that putting in those, that reporting and that kind of, in this case, professionalization of that layer of information sharing, is that something that you do as kind of a first step in your playbook, or it's case by case?
No, it's always a first step because we need to have visibility on internal operations. And in this case, the company had already invested in an ERP system that they had just not used completely. So we were able to flesh some of that out and get that up and running. So managers had availability of information. We had availability of information, could make decisions accordingly. And an external party, importantly, could have a window into the business that was reliable and accurate.
And what did the returns on that deal look like?
It was a 3.21 net MOA.
In 3 years.
Yeah.
Oh, great.
You mentioned the J curve, or I think you actually called it a version of the V curve. In your experience, what percentages of independent sponsor deals dip in EBITDA post-closing? How far is it acceptable to dip? And how long does it get to get back to the baseline?
Well, the underwriting goal is not to dip, but to reinvest. So if we're typically have at least nominal growth when we come on board, right? And all we're doing is we're saying, hey, we're going to reinvest some of that growth that would have contributed to next year's high teens growth, say. We're going to reinvest that. So it's more of a flattening. So it should have been, I'm trying to think of the best shape to describe maybe an angle, a trigonometric angle with maybe a 45 on the other side is what might make sense.
Great. All right, Craig. Well, let's leave it on trigonometric angle.
I hope that's a real word.
We wouldn't know to correct you.
Yeah. Well, Craig, thank you very much for coming on the Minds Capital podcast. Obviously, we are big believers in the independent sponsor model. So we always enjoy platforming kindred spirits on that point, and you are definitely one. So we really appreciate you sharing some of your experience and perspective with the audience. Craig Dupper, thank you very much.
Yeah, thanks, guys, for having me. I enjoyed it.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also, check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.